Hey, what's going on, my friends? In this video, we are going to talk about an emergency fund. Do you have an emergency savings account, an emergency fund? Maybe you're not entirely sure if you really should have it because, after all, you heard the market is kind of on the up and coming. It's kind of bouncing back after this kind of past few bloody weeks. And now people are like, hey, the money, it's raining money. It's time to start investing. And you just need to invest everything you got, invest your life savings, invest every penny you've ever earned because you know, inflation and you want to make money and saving accounts are no good. Well, I mean, yes, we're gonna jump into that. There's some truth there, a little truth there. At the same time, it's very critical. It's very important that you do have an emergency savings account set up, emergency savings fund, there to support you when you need it most. So I have two different articles here in which essentially it helps to explain why you shouldn't get caught up with, the FOMO and the Reddit and the Wall Street bet crowd, where you're putting all of your life savings, all of your hard earned money there inside the market, and you're not putting any on the side to help you when emergencies do come about. So, just jumping into this a little bit, and then we'll jump into that other article as well. But emergency savings can really come in handy when some of life's disruptions rear their heads. This could be a leaky roof, an unexpected medical bill, job loss, or even emergency surgery for a beloved pet. Experts typically recommend having 3 to 6 months worth of savings for a fully funded emergency account. So, unless you have, a spare $10,000 just lying around, it can take some time to build up a substantial emergency fund. But with inflation devaluing your money over time, it can be easy to feel as if you're wasting the growth potential of your emergency money by only keeping it in a savings account. But before you start researching investing apps, know there are a few reasons why you should rethink investing your emergency fund. And the most obvious number one reason is because you could potentially lose the money you invest. Generally, it's not a good idea to invest your emergency fund, period. I mean, I shouldn't really have to read this. I shouldn't have to explain that. Yes, I understand the upside. I understand the whole concept of risk versus reward. But again, this is your emergency savings fund. This is your, kind of that lifeline that's there to support you when you need the help most. And so jumping over here, as you can see, it's number one is the market is still risky despite its recovery. So like we just said, you could lose your money. Although things are starting to really bounce back, the S&P index is up a healthy 16% year to date. While it's certainly encouraging to know that we're far off of the lows of the 2020 flash recession, there's no guarantee whatsoever that this performance will continue into the future. Remember, the market is a risky place, particularly in the short term. You simply can't depend on the stock market to fund unexpected expenses, even if it has gone up substantially in the recent past. Nothing beats an emergency fund when the market tanks and you're in need of cash. So again, the market's doing fairly well where, yes, there's a little red, but there's green and people are killing it. People are doing well. People are making a lot of money. We're making a lot of money. We're making good money, especially with option trading, baby, some call options. Got to jump in puts. Haven't really jumped into puts much. But the market is doing really well. We're doing well. We're making good money. However, at any point, things can just tank and you can lose all of your hard-earned money. Number two, peace of mind is underrated. So having your money, all of your money inside the stock market can be nerve-wracking. So yes, well, your emergency fund won't give you Bitcoin-like returns and will, in all likelihood, lose money to inflation over time. It will give you peace of mind. An emergency fund of 6 to 12 months worth of living expenses is meant to cover necessities in the event of job loss or an unexpected surge in costs. This is another way of saying that emergency funds provide some form of comfort should things go airy in some area of your life. Wise financial planning involves a fair amount of judgment and prudence. People are often very poor estimators of how they'll feel in the future, but anticipating that you'll be happy to have cash at the ready should the market go south is probably a good prediction. Pay for the peace of mind and always have some liquidity on hand. And this is important even if you are someone who is heavily investing in the stock market. It's important to have a little cash on hand because at any time, at any point, things could take a turn for the worse. And it would be unfortunate if all of your money was already tied up in the stock market where you had nothing ready to buy on all of these great opportunities when the market is down. Remember, when it's red, that is a great buying opportunity. This isn't legal or financial advice, but generally speaking, that's a good rule of thumb I think most of you guys can consider and keep in mind. Number 3 is not every dollar needs maximum return. And this kind of aligns with the other, reason we just touched on. And it's just having that peace of mind, knowing that money is there despite knowing inflation is going to be kind of kicking it in the butt. So one of the main criticisms of emergency funds is that you won't earn much of a financial return. Most high-yield savings accounts, a common vehicle for holding emergency funds, pay somewhere between 0.25% and 1% annually, depending on how much you're willing to put away and how long you're willing to keep it stashed. But emergency funds have nothing to do with earning a maximum return. They have to do with providing balance and safety to an already diversified portfolio and provide you with options should you find yourself in a cash needy circumstance. Further, if you depend on the stock market to fund your emergencies, you'll be hurting your long-term prospects if you sell shares at market lows, because we don't know what the stock market will do next. As nobody does, it's best to plan for very good possibility that you'll need cash from a stable fund. And number 4 is portability and flexibility are extremely valuable. As inflation creeps up, valuations stretch, and the world accelerates its technological advancement faster than ever before. Portability and flexibility come at a premium. Being able to pivot to a new location, career, or life setup has never been more valuable. No matter how you use your ready cash, simply having an emergency fund ready provides some valuable options not available to those who opt out. From an investing standpoint, a healthy emergency fund may even allow you to add more to your stock portfolio in the event of an unexpected market downturn. And that's exactly what I was just touching on a moment ago, where, hey, if the market tanks and you don't have any money, any liquidity, any cash at all, well, then you miss out on many great buying opportunities potentially. So, emergencies can and do happen, my friends. They definitely happen if you've been fortunate to never have had a true emergency, or if you've never experienced an extended bear market. It can be difficult to know how you'll feel if both happen, especially at the same time. That's why it's imperative that you keep at least a minimally funded emergency account available for you to access at a moment's notice. The great news is that once you've built a healthy cash buffer, you'll be in an even better position to invest in the stock market for the long term. You'll also find that long-term investing, when combined with a fully funded emergency fund, is an efficient way to meaningfully grow your net worth over time. And one other really important thing to consider is that, hey, if you have that emergency fund and you take all that money out and you throw it inside of investing, well, you're going to owe taxes when you need to make a withdrawal. Yes, you forgot about our good friend, our Uncle Sam. Yeah, he wants his cut too. So keep in mind that when you invest money into a taxable brokerage account, you'll be responsible for paying taxes when you sell some shares and realize your gains. The tax rate you'll pay will depend on when you bought the shares and when you sold the shares. Profits made from selling assets you've held onto for 1 year or less are subject to a short-term capital gains tax, which will usually be the same as your regular income tax rate. On the other hand, if you sell your assets you've kept for over 1 year, you'll pay a long-term capital gains tax, the rate for which is between 0 and 20%. Generally, it's better to be taxed at the long-term capital gains rate since you'll typically owe less in taxes. But again, emergencies cannot be predicted. So having to sell your assets less than a year after buying them means you'll owe more in taxes. So instead of investing your emergency fund, consider contributing money to a high yield savings account. High yield savings accounts pay you interest each month just for keeping your money in the account. This lets you grow your balance just a little quicker, even if you aren't making regular contributions. Marcus by Goldman Sachs High Yield Online Savings and Adley Online Savings both offer 0.5% APY. The APY generally depends on the interest rates set by the Federal Reserve, so it can change and even increase over time. And I will throw out there, my friends, I actually have I have a number of accounts, but my favorite, I guess kind of like where it's my kind of, I wouldn't really say technically, actually, it isn't my emergency fund anymore, but Digital Credit Union is who I work with. It's a local credit union here in Massachusetts, but I believe it is online and you can work with them anywhere in the country, I'm pretty sure. And I believe they have a pretty high interest on the first $1,000. So I can't remember off the top of my head exactly what it is. It might be 1%. It might even be higher, but ultimately, again, it's that first $1,000 that they give you access to. DCU interest rates. 6.17%. Whoa. So your primary savings account. All right, my friend. So this is the real deal. DCU gives you a 6.17% APY on that first $1,000, I believe. Hold on, let me confirm. Yep, dividend rate is 6% up to and including the first $1,000. And then after that $1,000 on your remaining balance, your dividend rate is 0.25%. So, hey, that's not too bad, right? Not too bad at all. And oftentimes they say your emergency fund should, you should really start with $1,000. So considering this gives you over 6% on that first $1,000, and people suggest, you start with $1,000 first, why not consider working with a bank like DCU where you're going to get money, you're going to get interest on that $1,000, right? Not too bad. So when people are like, oh, don't put your money in a savings account, you're losing all your money, inflation's killing it all, and you're not going to have anything, Hey, if you got DCU, that first $1,000, you taken care of, baby. You taken care of. So I hope you guys found this video helpful. I know how tempting it can be to just be like, hey, the stock market's going well. You're seeing people around you doing well, investing, and you got all of these apps that make it incredibly easy to invest. Robinhood and Webull, M1 Finance, some of my favorites. And I know how tempting it can be to do it when, again, you're seeing people making money, when things are just flourishing, but you need to have that emergency savings in place. Now, quick little fun fact, I think I don't think I had my full emergency savings in place when I started to invest, but I also wasn't, doing risky moves, and my investing was being looked at as a long-term play. So I think my initial investing, actually, I don't know if you even, some people might not really say, well, this is different because it's your retirement. But it was my Roth IRA, I believe. That was like the first thing that I was like, I'm going to start to invest in this. And so for me, it was like a combination of, I know Dave Ramsey, and I'm going to dive more into this. I'll make a video talking about this, but kind of spreading the love where I didn't just tackle all of my debt at once. And I kind of was like, all right, well, let me focus on a few things where I was tackling my debt at the same time I was building up my emergency savings account. At the same time, I was starting to invest and build up my Roth IRA for my retirement. So, it might have been better for me to just say, hey, let's just put all my energy towards my debt. But at the same time, because the market was doing so well, and I saw so many great opportunities, it just didn't seem to make the most sense to say I'm going to just fully focus on my emergency fund now, when I can chip away there, and I can also chip away a little at my debt, and I can also chip away a little at my retirement planning. Again, everyone's different. The timing is going to be different depending on how well the market's going, where it might make more sense to put more of your energy towards paying off your debt, whereas other times it might make more sense to kind of focus on investing and growing your money because of the growth and opportunities around us. So I'm going to wrap it up there. I hope you guys found this video helpful. I know how tough it can be to start to really build up that emergency savings account, that emergency savings fund. A lot of people, on Instagram and YouTube and whatnot, they'll don't save and don't, forget their emergency savings account, just invest. I'm telling you, you want that emergency savings fund available for you when something happens, because if something happens today and you got all your money in a brokerage account, you got to, even if your money's there and you're doing fine, it still takes time to get that money. You need to be able to grab it and get access to it like today. So that's where the emergency savings fund is critical, is ideal, and really going to be a game changer when you need it most. So on that note, I hope you guys found this video helpful. If you did, definitely give it a nice thumbs up. Also, subscribe to the channel. Hit that notification bell so you guys can stay up to date on our latest and upcoming videos. And feel free to leave a comment down below letting me know what your thoughts are about the emergency fund. Do you have one already? How much is in yours? Do you have 3 months? Do you have 1 month? Do you have that $1,000? Do you have 6 months? Or maybe you have even more. Maybe you don't even have it. You said, you know what? Forget all that. I'm looking for the future in terms of investing, not for emergencies, this, that, and the other. Hey, to each his own. But I would love to hear what you guys think and where you stand when it comes to your emergency fund versus investing, if you even have one or don't or whatnot. So leave a comment down below. Let me know what you guys think. But all right, my friends, you already know I got to keep it moving. But I'll see you in the next video. Peace.